Hi all, welcome to the sixth episode of Direct Stock Investing series. Today's video will be a little different compared to the previous episodes because there are a lot of things happening in the market right now. So I thought I will briefly cover a few points what's happening in the current market. Along with that, I will also talk about the main topic for today's video, which is what is operational profit margin, return on equity, and return on capital employed. So I thought of discussing only those financial ratios. Those are considered as the most important big three ratios. But since a lot of things are going on in the market, I thought I will cover that as well. So what's happening right now, especially in the Indian market, is that a meltdown in IT stocks. I'm sure that most of you might have seen that. So what's actually happening? In the US, the company named Anthropic, their LLM model, Claude, they came up with new uh, capabilities in which a lot of manual work can be automated, right? So if you read about Claude's new features, many legacy works can be done within a second, or within much less time compared to what the average time it takes right now. So if you know, almost all the IT companies, most of their works are around uh, repetitive tasks. Because of that fear in which all those jobs would be eliminated in the future, investors are scared that Indian IT companies have very limited scope or very limited future, and there is massive sell-off. You can see that in Infosys, TCS, Wipro, all the IT companies were sold off drastically. These are the big companies, even mid-cap, small-cap IT companies, everything sold off like anything, right? So what's the future of IT companies, especially the service-based companies of India? So my personal opinion is that I'm pretty sure that all these companies, they have massive cash flow. I know that there is an ongoing debate going on where why these companies are not investing their cash into R&D, right? Usually they will do a buyback or they will distribute the cash in the form of dividend. So many people argue that they are wasting their cash, they are not innovating enough. But even having said that, since they have a massive lot of cash, they can put that into future investments, right? I mean, they can innovate if they want to. How are they going to do it? Nobody knows. I mean, right now we don't have any visibility, but I right now I won't write off them completely. I think they will definitely come back, and the nature of work that they are going to do will be somewhat different. And also in terms of the sell-off, right? You can see that during the COVID peak, TCS was trading around 30 PE. Right now it came down to uh, 20 something, 2021 PE. 40 to 50 percentage reduction, 40 percentage of reduction in their PE. So right now what's happening is that most of the IT companies PE is getting derated. Earlier the PE was 25, 27, 30. Now it is trading around 18, 16, 18, 20 range. If you see the profit and loss statement, there is, until now there is no massive gap. I mean, growth is reduced, but they are still making good amount of money. So that's what I want to talk in terms of what's happening in the IT sector right now, where people are completely writing off. But I would say it's too early to think that Indian IT service companies are, going to bankrupt or they have very weak future. Having said that, I also want to talk very important point because uh, this is something I thought it requires immediate attention. That is, stock market is primarily driven by greed and fear. When the market is rising, the fear of missing out, FOMO, kicks in, and people want more and more and more. They want to catch that entire rally. So they are not satisfied. They want more. I mean, so it's quite natural. The greed kicks in. If you double your money, you want to triple it. You want 5x, 10x. You see the recent examples of gold rally, silver rally, right? Everywhere you can see that. I recently read a data that last month, January, the commodity ETF flow has surpassed the equity ETF flow. That means more and more people are putting money into commodity than equity. Why? Because last couple of months, gold and silver are rallying like there is no tomorrow, right? And when the market is falling, what's the emotion? The emotion is fear. People think that there is no tomorrow, and the next immediate option is selling everything and be free from the market. So that's what right now happening in the mid and small cap, also in the IT sector, where people think that these companies are not going to perform and I have to come out of it. Fear, extreme fear. Same thing happened in COVID time, March 2020, where the exchanges had to stop trading because of the massive selling. I still remember what happened during that last week of March, where Nifty is falling like anything, stocks are like crashing like anything. Investors are scared because there is darkness everywhere, right? There is no visibility on what's going to happen tomorrow. Stock market is always like this. Investors are always like this. The emotions are either greed or fear. How can a normal retail investor outperform the rest of the investors, right? So to talk about that, we also have to talk about what's happening, not just right now, in general. People are always short term. People, they are not ready to invest long term. That's very few people are. What's happening right now? They will start an SIP in a particular fund. They will invest for maybe 1 or 2 years. If they have good money and if the market has rallied, or if the market is crashing, they will slowly withdraw the money. Maybe they will travel, maybe they will use it for something else. They will buy an iPhone, or they will buy a two-wheeler or car, or whatever. Depending upon the size of their portfolio, they will do, or they will spend that money. What's actually happening is you are actually disturbing the compounding, right? So many things I want to talk a lot, but it maybe I will break down all these concepts in the upcoming videos. But this I want to tell that once you break the compounding effect, right, it's very hard to rebuild it again, because time is the best thing that you have when you are young, and the number of years that you invest going to matter a lot. The next immediate thing that everyone asks is, what is your edge in the stock market? So if you are a short-term investor, there is no edge, because everyone knows what's happening around a company. Everyone knows market will go up, market will come down, silver will go up or silver will come down. For a short term, there are a lot of technical indicators, momentum indicators. People will ride that momentum and they will make the money and quickly come out of it. So if you are lucky, you will make money in the short term. But is that the right approach? For some, maybe, but I would say there is no edge in that. The real edge for you is when you invest for long term, because some companies, they need a couple of years, 2-3 years, to expand or to establish themselves and to start delivering good output, good results. So when you have a long time horizon, the odds are that you lose money is very less, and the odds are that you make massive money is so high. I will quickly talk about one example, one story, and then we'll move to the financial ratios. We all know that the stock Nvidia, which is right now the largest company by market cap, right? It gave massive returns in the recent past. But do you know the story behind Nvidia stock, especially the stock? Nvidia IPO'd in the US market in 1999. And if you see the history of the Nvidia stock from 2000 till year 2015, basically 15 years, Nvidia stock had given zero returns, negligible returns. 15 years. But from 2015 to 2021, within 6 years, it rallied 60 times. That means if you would have put 1 lakh rupees in Nvidia in 2015, by 2021, that 1 lakh would have been 60 lakhs. In 6 years, 60x. But again, the story is not ending here. From 2021 to 2022, from the top, within 1 year, the stock had fallen close to 70%. That means out of that 60 lakh, your 1 lakh became 60 lakh. Out of that 60 lakh, 42, close to 40 lakhs had evaporated within a span of 1 year. So that 60 lakh became how much? 20 lakh. Then again, what happened after that? From 2022 to 2025, the stock had rallied another 17 times. So again, that 20 lakh would have become how much? 17, 3.4, 3.5 crores. So within 10 years, I would say 1 lakh would have been 3.4, 3.5 crores, which is 350 times in a span of 10 years. But do you know, like before 2015, from 2000 to 2015, 15 years, zero returns. How many of you have that, or how many of us have that patience to hold a stock with zero returns and having that conviction to keep on holding that today or tomorrow the company will perform? Or even when the stock had rallied in 2021 60 times, if the stock crashed 70%, do you have that stomach to hold the stock thinking that this will come back? How many of us have that strength to carry a stock even if it falls 50%? Forget about an investor. You think about a person, right? The founder of Nvidia, Jensen Huang. He is the founder. He founded Nvidia in 1993. And he is working on a larger mission. He has no interest whether the stock had up or down. 15 years, no return. Is he bothered? No. He's only bothered about building quality products, right? And the results are visible now. So that's the power of long-term thinking. Now, do you think, is there any competitor for Nvidia? People are saying that there is nobody who can right now compete with the GPU that Nvidia makes. All the LLM models who need Nvidia GPUs, nobody has able to deliver that kind of capacity with which the speed with which the data processing happens. So the company Nvidia, they invested a lot of their resources, time, energy, everything in building quality product. Same with all the tech companies. You take Amazon. Amazon stock had fallen 90% in the 2000 crash. How do you justify the people who had invested and made money later on? Do we have that guts? If we have, we will make massive wealth. So that's the power of long-term investing, long-term thinking. Always think long-term. That's where your real edge is. So yeah, that's about right now what's happening in the IT sector. And if you see the Nifty earnings growth is slowly picking up. The problem currently in the Indian market is that a lot of good things had done by the government. So there is a disconnect between the economy and stock market, because uh, whatever the reforms that had happened, due to some reason, I don't know what is the reason, I am still looking into that, it's not reflecting in the performance of the uh, companies. So slight uptick is there, auto companies are doing better, few rural demand is picking up, but there is a lot of disconnect between the economy and the earnings of companies. So hopefully it will improve going ahead. Let's see. Now let's come back to the main topic of the financial ratios. So where we left. So just to give you a glance, we talked about a company named ABC, deals with hotel, right? It's a hotel business, and there are three directors, three promoters who is owning the company, and they have multiple branches, and it has IPO'd into the stock market. We talked about all these things, right, in the previous videos. So the stock ABC is trading in the stock exchange, and if somebody wants to buy, they want to know what is the operating profit margin. What do you mean by operating profit margin? Operating profit is nothing but the money generated by the company, in this case the hotel, after the expense like salary, raw materials, power, all sort of expenses, before paying the interest if they have taken a debt or something, and before paying the tax, right? So the profit that the company had made after expenses before paying interest and tax is known as the operating profit margin of the company. And we talk it in terms of percentage. So if a company has good operating margin, that means that company is very good for investing. Why? Because it has a good purchasing power. Another reason would be they have premium products where the customers are ready to buy. For example, like maybe you can uh, say an Apple phone where the product is premium, people will buy because of the brand, right? So that's what we call as OPM, operating profit margin. And the next ratio is return on equity. So return on equity is nothing but how much profit a company generates for every 1 rupee that belongs to the shareholder. Formula is the net income, basically the profit of the company divided by the shareholder equity multiplied by 100 is what the return on equity. And why return on equity is important? It establishes a very important point in which uh, how well the company is using their cash, or how well the company is managing the money, right? So typically an ROE of 15 or more than 15 is considered as a very good ROE. So that means that company is doing great work. And the third financial ratio is ROCE. So in ROE, actually the company can inflate the ROE by taking a lot of debt. So debt is not considered while calculating the ROE. But when it comes to ROCE, right, it's like the holistic ratio. It is much more important than ROCE. Here the equation is little different. Here it's not the net profit, it's the EBITDA, or the profit before pre-tax profit divided by the shareholders equity plus the debt taken by the company. So all this comes to multiplied by 100, of course, because both ROE and ROCE is calculated in terms of percentage. So here also ROCE tells you on an overall basis how well the company is managing the money. And if an ROCE of greater than 20, that means the company is doing really great work. For example, the company has some debt, right? And if the company is paying, say, 8% of interest for the debt that the company had taken, and from that overall money, the company is able to generate 10% or 15% of ROCE returns, that means the company is doing great. They are only paying 8% of interest, but they are making 10-15% in returns. But say, for example, the interest is 8% for the debt, and the company is only generating 6%. That means slowly the company is losing money, and eventually it can collapse, right? So while dealing with stocks, before investing into stocks, you have to check what is the operating profit margin, OPM, what is the ROE, and what is the ROCE. Ideally, I would say for a good investment, operating profit margin should be more than 15. I would say 20 means very good. ROE of more than 15 and ROCE of more than maybe 18 or 20. Ideally, ROCE should be better than ROE. So you can consider 15, 15, 15, all three in 15, or else if you can find companies with 20% OPM, 15% ROE and 20% ROCE, great. But it's very hard to find such companies with decent valuation, right? Investors know that they are doing great business, so they eventually purchase the company and the valuation would have gone up. In the previous video, I talked about PE ratio, right? In which if the PE is 50 or 60, then it's very difficult for you to make money unless the company is continuously making good profits year after year. Classic example is companies like Hindustan Unilever, ITC, Nestle. Lot of companies where operating profit margin, ROE, ROC, all are great, but except ITC, rest of the stocks are trading, HUL trading at 50 plus, and Nestle I think recently touched 80 PE, right? So very hard. Why ITC is trading in 20% or 20 or less than 20 PE? Because of the taxation issues. Investors think that long term it's very hard for them, to expand the volume growth in cigarette business. So there is uncertainty, but more or less it's resolved now, but investors are not keen on investing into ITC. ITC case study is a totally different subject. Maybe I will talk or I will do one video on what's happening in ITC. Hope I'm clear on what is OPM, what is ROE, and what is ROCE. In the next video, I will talk about how to select a stock, what are the prerequisites or what are the parameters that you have to check before investing into a stock. I know today's video was little long. I talked about the IT company issues. I talked about what the mindset of investors, short term, long term, the Nvidia story, and also I talked about the financial ratios. So yeah, probably by next video onwards, you will be in a good position to pick a stock by yourself. After next video, you will be very confident on at least what are the things that you have to check before picking a stock for long-term investing. So if you are liking the content, again, do subscribe to the channel. The series is not ending. I am planning some others, one other series also around money management. So a lot of content coming up. The only issue is like the time management, but I'll make sure that I will be more regular here. And yeah, if you have any questions, please comment below. I'll come up with episode 7 soon. Till then, take care.